Let's bring in Ayako Yoshioka of Wealth Enhancement Group, as well as Peter Cecchini of Axonic to talk more about this. Aya, how would you feel about the way the market is postured ahead of tomorrow's number? Now, on the one hand, the market maybe was an excuse to pull back, looking for an excuse to pull back on almost anything. On the other, you know, the yields have gotten up into the zone that has become uncomfortable for stocks a couple of times in the last couple of years.
Yes. Hi, Mike. Thanks again for having me. And, we've talked about this a couple of times in that, the current interest rate environment, yields going higher, valuations being relatively elevated, at least in the near term. And then, economic data that's been relatively resilient, but expectations are for a continued slowdown, maybe at a pace that's not as bad as everybody initially thought. But that combination isn't typically the combination that pushes markets higher. So we expect at least a little bit of a pullback, especially as we head into earnings season.
Peter, that's certainly very true that combination is not typically what would be a bullish formula for stocks. But there's been a lot that is atypical, isn't there, about this current cycle, or at least it's an elongated process. I know you've been kind of looking for the economy to weaken. Here we are, I think, trying to contend with data that say, OK, we might be heating up again on the economy. What's your read?
Yeah, I think the June numbers were strong. That ADP print, if it's not revised, was unequivocally strong. Payrolls will obviously tell more of a story tomorrow. I do think the trend, though, has been for weaker. PMIs have been weakening. ISM has been weakening. The trend has clearly been weaker there. Initial claims, which bottomed out around 180,000, hit about 265. They were a little bit stronger this morning, meaning fewer claims. But I think the trend is a little bit weaker, and people get carried away. We have recency bias relative to the more recent prints. But at the end of the day, I think, this long and variable lag that Jerome Powell even admitted is even longer and more variable than normal will eventually manifest. We had an unprecedented stimulus coming into this. And I believe that stimulus and the pent-up savings have prolonged the cycle a little bit. Defaults are rising, Mike, especially in weaker middle market companies. We can see all the telltale signs. And never have we not had a recession with the yield curve this inverted and with lending standards this tight, going back to 1964.
If you boil that all down, Pete, does that mean that, this is a huge buying opportunity for treasuries because of the backup in yields we've seen?
Yeah, we are contemplating that, right? This might be the time to receive in swaps. The instance in which it would not be, Mike, I think would be if the Fed were to, quote unquote, lose control. We don't think that that's going to be the case. But yes, over the next 6 months or so, there will be a point in time where becoming bullish of the long end will make sense if, in fact, our economic forecasts are anywhere near correct.
And on a practical level, what areas of the market would you feel comfortable with in terms of fresh money, putting it in there, given the environment doesn't necessarily, to you, look like it's a necessarily attractive combination?
Sure. So as Peter said, we like fixed income as well. But if you want to stick to the equity markets, we do see some pockets of value. Healthcare hasn't done as well this year as much as tech has. And we think industrials also offer some good value. And then lastly, small caps have really sort of been left for dead. And the differential between small cap valuations and large cap valuations has widened to an area that we feel that small caps could be attractive going forward.